US house prices, as according to many analysts, are apparently continuing to defy gravity, which is now for the third year, as the latest data to March 2015 has house prices rising by 0.8% on the month on the Case-Shiller 10-City Index Composite, which nevertheless did give some hope to the doom merchants, as momentum has plunged, or as they would like to say, crashed from 14% inflation rate of a year ago to a sub 5% inflation rate, as the momentum graph illustrates. The relentless grind higher in US house prices has been accompanied by a consistent stream of reasons in the mainstream press and blogosphere for why the bull market's demise was always imminent, the most recent of which is to assign the current slowdown in momentum as a consequence of the likes of Saudi Arabia's war on the US shale oil industry, which is resulting in an economic slowdown, or that the Fed surely must soon start to raise interest rates, which is ignorant of the reality that central bankers will only raise interest rates when they are forced to do so by the markets, namely to prevent a wage price spiral, or support a plunging currency, or to halt a bond market panic, all of which are crisis events rather than one of central bankers signalling orderly intentions. As it should not be forgotten that zero interest rates are a panic measure. Therefore, contrary to the Fed's pronouncements, Fed policy remains in panic mode, which means it will only be a greater panic that prompts actions to raise US interest rates. Again, I need to emphasize the point that interest rates since late 2008 have been in panic mode. There is nothing normal about zero interest rates or negative real bond yields, as the prospects for interest rate hikes should be viewed on as a result of a reaction to a greater panic, for there is no free lunch as you cannot print economic growth. Therefore, you can forget all of the noise in the mainstream press about the Fed raising US interest rates, because it is more probable that the Fed will cut interest rates, or likely manifesting itself in more QE, i.e. the exact opposite of that which the mainstream press has been obsessing over for the whole of this year. Remember, you heard it here first, that the Fed is more likely to loosen monetary policy than tighten. Where US house prices are concerned, rather than listing a long series of pronouncements from those who in large part will be unknown market commentators, I will once more just list the utterances of the widely recognized king of US housing market data, Professor Robert Shiller, who once more recently warned not just against high housing market valuation, but also for stocks, a bull market for which he neither saw coming and has been caught on the wrong side of for many years. To further illustrate the point, Robert Shiller's current comments are pretty much the same as he was stating a year ago. So what do academics such as Robert Shiller repeatedly miss? They miss the significance of momentum and sentiment on trend, which is accumulative, as I've covered many times over the years. US house prices are already rising at a rate of over 12% per annum. This whilst the mainstream press continues to remain largely skeptical in its commentary, as illustrated by Peter Schiff's article in Forbes magazine of early April 2013. What the academics and journalists fail to understand about markets is that markets are not primarily driven by fundamentals, but by sentiment, and it is sentiment
that creates the fundamentals, which is why academic economists are nearly always looking in the wrong direction, because they are looking at the cause rather than the effect, as it is the effect that makes itself manifest in the price charts long before cause appears in the economic data. As house prices rise, homeowners see the value of their assets rising, so are more disposed towards consumption, which drives economic growth.
So enough of the academic noise and the mainstream press that tends to regurgitate academic theories and sales pitches from the financial industry. Instead, I refer to my long-standing forecast for US house prices covering the period November 2012 to early 2016, which is now entering its final leg.
My forecast conclusion is for US house prices to experience an accelerating trend over the coming years, as each year's percentage gain prompts higher gains in the following year as a consequence of ever improving market sentiment that will lead all the way to the next bubble, which is many years from now. Therefore, my forecast conclusion is for the embryonic bull market of 2012 to morph into a real terms bull market of 2013, where each year builds on the preceding year's momentum all the way towards an average price gain of over 30% by 2016. This translates into a precise forecast for the Case-Shiller CXSR index to rise from the most recently released data of 158.8 released in December 2012 for October 2012 to target a rise to 207 by early 2016, or a gain of 30.4%. There are several potential ways to play the unfolding housing bull market, the lowest risk of which is to buy a house to live in. The next risk would be to buy to let as a landlord, and the highest risk being to buy bank and house builder stocks, which tend to be highly leveraged to house prices. Before you all rush out and buy, a word of caution. That is that I am anti-borrowing money, so don't make the same mistake as many made during the last housing bull market, which was to fall for the bankster con of getting you addicted to lots of cheap money and then taking the drug away and then waiting to foreclose when you can't make payments on your mortgage. And finally, ensure you are subscribed to my YouTube channel for regular updates on this and other forecast trends such as the stock stealth bull market, commodities, the inflation megatrend, and many other markets such as the UK housing market.
By the start of 2014, a year into the forecast, US house prices had soared to well ahead of my forecast trend trajectory, which I then thus expected to slow sharply during 2014, as I expected US house prices to converge towards my forecast trend trajectory during the year. By mid-2014, the expected slowdown had begun, and that I expected US house prices momentum to further weaken as prices continue to converge towards the forecast trend by the end of the year. My US house prices outlook for 2014 update of early January concluded in expectations for a sharp slowdown in US house price inflation during 2014, as I expected house prices to converge towards my forecast trend trajectory. The latest US house prices data released for May 2014 shows that US house prices are gradually converging towards trend forecast, with prices now standing at forecast plus 5.3% deviation against plus 7.4% deviation in January, based on October 13 data. US house prices momentum continues to slow from a peak of plus 13.9% for November 2013 data to now stand at plus 9.2% for May 2014 data, with the trend looks set to continue to under 7% inflation before the end of this year, probably bottoming out at around plus 4%, just as the doom merchants become most vocal on the end of the US housing bull market mantra. So, in conclusion, continue to expect much more doom and gloom to accompany the slowdown in US house price inflation during the remainder of this year, which in reality would just be house prices oscillating around the central trend forecast of 10% per year. This will sow the seeds for the next surge higher during 2015 and ultimately all the way to new all-time highs in a couple of years or so. The latest US house prices data released for March 2015 shows that US house prices have now fully converged towards my forecast trend, with house prices now exactly tracking the trend forecast. So despite mainstream media's persistent noise for an increasingly negative outlook for US house prices for a multitude of reasons, the misperception for which is supported by the recent sharp drop in house price inflation to plus 4.7%. Instead, the continuing reality is for US house prices just oscillating around the central trend forecast of 10% per annum, as long as the long-term trend trajectory remains intact for a rise of over 30% by early 2016, for which US house prices have about a year's worth of price data to come. Therefore, I see no reason to undertake a more in-depth analysis at this point in time by delving into the fundamentals of the US housing market, such as looking at mortgage applications, housing starts, existing and new home sales data, as the price has trended towards full convergence. Thus, US homeowners can look forward to at least another 9 months of rising trend in house prices that I'm sure will be accompanied by much gloom and doom commentary that I suspect will continue all the way towards new all-time highs for average US house prices, which I'm sure itself will trigger much end of the bull market double top mantra by that time. So ensure you are subscribed to this YouTube channel for more in-depth analysis and detailed trend forecasts for not just the housing markets but for the whole array of financial markets.